Hmm. Hello, everyone. Our today's lecture is series of UK taxation for businesses and individuals. First lecture of this series, and today's topic is understand advanced aspects of the UK taxation systems. So, welcome and good morning, everyone. This lecture is about, as I said, UK taxation for both businesses and individuals. Uh, I hope by the end of this lecture, you will have a strong knowledge of the key taxes in the UK and how they apply to different situations. Also, you will be able to analyze tax information and explain it clearly, which is valuable skills for your accounting career. Uh, anyone is there? If anyone is there, can you please introduce yourself? Can you hear me, Pippa? Hello? Can you hear me? Hello? No. Can you hear me? Can you speak? Can you hear me? Or is there any issue with your voice? Uh, any technical issue?
Hello?
Yes. Can you hear me, Pepper?
I can hear you, yes.
Okay. How are you? Just a little bit introduce yourself.
I'm James. What kind of things do you need to know?
No. I mean that you're studying, you're practicing, or you are doing.
I'm practicing. I work for the accountants in.
Okay. So you are UK based. I
Yeah.
hope you are. Okay.
Yeah.
Okay. Thanks, Pepper. Thank you very much. Hi, Hinesh. How are you? You okay? Okay, let's get started, Pepper. Okay.
Okay.
So thank you very much. Okay. If any issue, just ask and I will try to explain.
Okay.
Okay. Hi, Hinesh. How are you? You okay?
Yeah, just
Nice to see you.
feeling great.
How's your health anyway? Are you okay now?
No, I have to go
Oh.
for an appointment. Yeah.
Oh, okay. Okay. Let's get started first. So this, as I said, this is a first lecture of business taxation and UK taxation for businesses and individuals. Today's topic is understand advanced aspect of the UK taxation system, which is learning outcome first. So unit aims, this course builds on your existing knowledge of taxes and takes it step further. So we'll explore familiar taxes like income tax, corporation tax, capital gain tax, and inheritance tax. We will also discuss into some new areas, including taxes for international businesses and activities. Trusts are tax different taxes, breaks and exemptions. So we will focus on developing your ability to analyzing tax information. Right, indicative contents, scope of income tax, income for employment, income for self-employment, property and investment taxes, property and investment income, comprehensive computation of taxable income and the income tax liability, national insurance contributions, used for exemptions and relief in, deferring, where is gone? And minimizing income tax liabilities, concept of residence, domicile, and deemed domicile, chargeable gains and capital gain taxes, scope of the taxation of capital gains, basic principle of computing gains and losses, gain and losses on the disposal of movable and immovable property, uh, gains and losses on the disposal of shares and securities, the computation of capital gain taxes. Then use of exemptions of reliefs, disposal of capital assets, inheritance taxes to include scope of inheritance tax, basic principle of computing transfer of values, liabilities raising on chargeable on the death on of the individual's calculation of inheritance, payment system, liabilities arising the chargeable lifetime transfer and death of individuals, use of exemptions in deferring the minimizing inheritance tax and liabilities. Okay, so corporation tax include scope of corporation tax, taxable total profit, chargeable gain for companies, comprehensive computation of the corporation tax liability, effect of group corporation, structure of corporation tax purpose, use of exemptions and relief in deferring and minimizing corporation tax liabilities. Stamp taxes, what stamp taxes and are and when they apply, often on property purchases, different types of stamp taxes, liabilities that can arise during transfer of property and other assets, VAT, scope of VAT, VAT registrations, cash and accrual system of accounting VAT, computation of VAT liabilities, special scheme of accounting VAT. So anyone can see my screen? Can you hear my voice as well? Okay.
Yes.
Okay. So here, can you see that we'll start our discussion with income tax with the normal rates. Basically, it's talking about rates, and income tax rates vary depending on your income level. For individuals earning between £1 and 37,500 pounds, the basic rate is 20%. And for individuals, it's 7.5%, sorry, for dividends, 70.5%. For those earning between 37,500 and 150,000, the rates increases to 40%. What's your name? James or Hanesh?
Yes.
Yes.
Is it about up to 125,000 pound? If I'm not wrong, you're practicing.
Sorry,
Mm.
that figure may have been reduced due to the new budget.
Yeah, is it 125 pound?
25,000.
Yeah, that's what I'm saying, that I think so, that I believe it's a 125,000 pound up to, which is 40%, and
So,
then 45% above.
so the syllabus for IFA, is that not based on the previous?
No, it's basically they are talking about, I think so, between 2019 and 20, something like that. So I am just thinking that is 125%. But this syllabus is, I think so, correct as per today. So, but I will check. I'm just thinking if you guys are practicing, so it is 125% or 150%. But let me see. I think so that is a 150,000 pound. Okay. Is a 45% under above 150,000 pound and over. Yeah, that's it. I just can see here. This is a right one. 150,000 pounds and above is a 45%. So, and 32%, 150,000 pound, the rate increases of 40% for income and 32.5% for dividends. So beyond 150,000 pound, the additional rate applies, which is 45% for income and 38.1% for dividends. So let's talk about personal allowances. Uh, everyone is entitled to certain amount of income that they don't have to pay tax on. So for the current tax year, the personal allowance is 12,500 pound. Additionally, there is a transferable amount of 1250 for some individuals. Residents status is also important in determining tax obligations. Also, individuals who have been previously residents in the UK may be automatically considered not residents if they have no ties in the UK. Conversely, they may be considered resident based on their number of ties they have to the UK. Child benefit. Uh, the child benefit income tax charge, if your income falls between £50,000 and £60,000, you will incur tax charge on child benefit received. So this charge amount to 1% of the child benefit for every £100 of income over £50,000. Car benefit, the percentage rate for petrol cars and diesel cars meeting the uh, RD2 standard are determined based on their CO emission. For cars emitting 50 grams per kilometer or less, the percentage rate of 16%, emission ranging from 55 to 75 grams per kilometer, it's 19%, while the emission between 76 and 94 grams per kilometer, it's 22%, then 95 grams per kilometer or above, it's 23%. Moving on the core fuels benefit, basic figure for calculation is 24,100. This is used to determine the tax benefit of having access to company provided fuel for private use. For company van benefit, the scale charge is set of 3,430 pound and the van fuel benefit is 555 pound. Individual saving accounts or ISA have an overall investment limit of 20,000 pound, providing individuals with a tax efficient uh, way to save or invest their money. Property income basic rate restrictions applies to 75% of finance costs related to residential properties, impacting tax calculations for property owners. When it comes to pension schemes limits, there is an annual allowance, a minimum allowance, and an income limit. So the maximum contribution that qualifies for tax relief without any earning is £3,600. For approved mileage allowance for cars, there are set rates 45p per miles for up to 10,000 miles and 25p per mile for mileage exceeding 10,000 miles. Lastly, it's capital allowance rates for allowance dictate rates of allowances for different assets. For plant and machinery, the main pool allowance is 18%, while for the special rate pool, it's 6%. Uh, for motor cars, the rate vary based on CO emission ranging from 100% for new cars with emissions up to 50 gram per kilometer to 6% for uh, cars with emission over 110 grams per kilometer. The annual investment, next is annual investment. Can you see my screen clearly? Hear my voice as well? No issues?
Yes, fine.
Okay. See, the annual investment allows businesses to deduct the full value of qualifying expenditures on assets from their taxable profit. The rate of allowance is 100%, meaning business can deduct the entire cost of eligible assets up to a limit of £100,000. Moving on a cash basis accounting, uh, cash basis accounting, this method allows small businesses to calculate their taxable profit based on money in and out of their businesses rather than using traditional accounting methods. The revenue limit for use cash basis accounting is £150,000. Corporation tax, which is the tax applies on the profit of companies for the financial year 2019. Okay. 2019 financial years, the corporation tax rate is 10%. The applies to profit up to £150,000. value added tax is a consumptions tax applied on goods and services. I hope everybody knows about VAT. Is a most common one. The standard rate of VAT is at 20%. There are registrations and deregistration limit for VAT, which are 85,000 pound and 83,000 pound respectively. Then finally, inheritance tax is a tax on the Hinesh, as you know that we discussed inheritance tax. You know that.
Yeah, we talked about it.
Yes.
So yeah, it's based on when
Yeah, the property, money, and possessions of someone who has died. Okay, so basically, the nil rate is the nil rate band is 3,000, 25,000 pound, and there is a residence nil rate band of 150,000 pound. So the rate of tax on the excess over the nil rate band is 20% for lifetime gifts and 40% for death. Then is a capital gain tax. Anyone can explain about capital gain tax? Anyone?
yeah, it's on assets that you make a surplus gain from the proceeds from its original purchase price or purchase cost, less the relief you get from indexation.
Yeah, spot on. So basically, capital gain tax is a tax on the profit made from selling certain assets. Okay. The normal rates of capital gain tax are 10% for basic rate taxpayers and 20% for higher rate taxpayers. For residential property, the rate are 18% and 28% respectively. Uh, Again, national insurance contribution or NIC, everybody knows, are payments made by employees and employers to fund state benefits. The class 1 contribution rate is 12% with a profit threshold of 8,632,000 pound per year for employees and a rate of 13.8% for employers on earnings above 650,000 pound £1 per year. Interest rates are important in financial calculations. The assumes official interest rate is 2.5%, while the Bank of England base rate is 0.50%. So finally, there are standard, penalties for tax errors which vary based on taxpayer behavior. For example, maximum penalty for deliberate and concealed errors is 100%, while the minimum penalty for prompt disclosure of a careless error is about 15%. This is a UK tax system, serves several purposes, uh, including funding government expenditures, redistributing wealth, influencing economic behavior, and promoting social objectives. So in terms of structures, taxes can be categorized in two main types: direct taxes and indirect taxes. So direct taxes are applied directly on individuals or businesses such as income tax and corporation tax. Uh, Indirect taxes, on the other hand, are imposed on goods and services such as VAT and excise duties. HM, Revenue and Customs, is the government body, HMRC, responsible for administering the UK tax system, ensuring a compliance with tax laws and collecting tax on to the government. tax law and guidings. In the tax laws, there are several sources that provide the foundation for understanding and applying tax registration. So these including case laws or statute law, detailed regulation in statutory instruments or SIs and HM revenue and customers guidelines. Statutory law consists of Act of Parliament, which are primary source of tax legislations. Case laws, on the other hand, is established throughout judicial decisions and helps interpret and clarify legal principles. Method of operating a business. Businesses, taxes, sole traders, partnerships, and companies. Operating a business involves navigating various tax considerations depending on the structure of the business. There are main three, kind of businesses. Normally, we talk about sole traders, partnership, and companies. So these are common forms of businesses, entities, such each subject to different tax implications. If we talk about sole traders and partnerships, are typically taxed on their trading profit as income tax, and they may also be liable for capital gain tax on gains from businesses' assets. Additionally, they are required to pay national insurance contributions. On the other hand, companies pay corporation tax on their trading profit and may also be liable for corporation tax on gains from business assets. They also have obligations related to NIC or national insurance contribution. Although this aspects is not covered in this syllabus. Types of income. Anybody can quickly? Hinesh or anyone?
Income from individuals will be salaries or from if they're retired from their pension or from their share dividends, whilst with corporates, incomes are from revenue that they generate from goods and services.
Yeah, that's correct. Income can take, various forms for individuals, including income from their businesses, trading income, employment income, bank and building society, interest, then property income, and dividends. So all these types of incomes are considered in the income tax computation for a tax year, which runs from April 6th to April 5th of the following years. For example, 2016 to 17 tax year runs from April 6th, 2016 to April 5th, 2017. So understanding the different sources of income is essential for accurately calculating and reporting taxable income to tax office or HMRC. So total net taxable incomes. Understanding the concept of total net taxable income is important for tax computations. So total income companies compasses all type of income earned by the individuals. Net income is derived by subtracting any trade losses from total income. Taxable incomes is calculated by deducting the personal allowance from net income. Then personal allowance set at £11,000 for the 2016 and 17 tax years. So serve as a tax-free threshold. However, the allowances is gradually withdrawn for individuals with net income exceeding £100,000. Once net income surpass £122,000, the personal allowance become nil. So when applying the personal allowance, it is deducted first from non-saving income, then from saving income, and finally from dividend income. Tax computation involves a structured approach to calculate the tax payable based on different types of income. So, firstly, total non-saving savings, interest, and dividend income are calculated separately. Next, the personal allowance is deducted from each category of income, starting with non-saving, then saving, and finally dividends. Taxation of taxing income. Taxation of income follows a the saving income and dividend income, following a hierarchical order. Non-saving income is taxed first, followed by saving income, and finally dividend income. So different tax rate applies to each type of income. Non-saving income is taxed at 20% basic rates, 40% higher rates, and 45% additional rates. So saving income is subject to 0% starting rate up to £5,000, followed by 20%, 40%, or 45% rates. Dividend income is taxed at 0% for the first £5,000, 7.5% basic rates, 32.5% higher rate, or 38.1% additional rate. So for saving income, starting rate applies if non-saving income is less than £5,000 for the tax year 2016 and 17. Tax avoidance and evasion. Anyone can tell me difference between avoidance and evasion? Which one is legal and illegal, and you know that consequences? Anybody can?
Yes, avoidance is legal prior to HMRC approval, and evasion is illegal, where there are very clear, explicit rules by HMRC and by law stating that these practices are not accepted by the regulators.
Yes. Basically, tax avoidance and evasion are two obviously different concepts with significant legal implications. Tax evasion involves illegal activities aimed at deliberately deceiving tax authorities to reduce tax liabilities. This can lead to severe penalties, including fines and imprisonments. In contrast, tax avoidance refers to the legal exploitations of loopholes in tax legislations to minimize tax liabilities. Currently, legal tax avoidance may still attract scrutiny from tax authorities and public opinion. Uh, then tax planning. Tax planning involves legitimate strategies to utilize available tax reliefs in a manner introduced to minimize tax liabilities, ensuring compliance with tax laws and regulations. This can done by your accountants, financial advisors, and solicitors in some cases. So allowable and disallowable expenditures, when computing taxable trading profit, it's essential to distinguish between allowable and disallowable expenditures. Allowable expenditures refers to expenses that can be deducted from accounts profit to calculate taxable trading profits. But disallowable expenditures cannot be deducted from deducted and must be added back to the account's profit. Disallowable expenditures includes fines and penalties, depreciations, amortization, salaries, interest paid to sole traders or partners, private expenses of the traders, capital expenditures, entertaining legal fee, journal provisions, any expenses not incurred wholly and exclusively for trade purpose, political donations, charitable donations, unless small and local. Analyze income and income tax liabilities relating to overseas aspect of organizational activities. Right. So analyzing income and income tax liabilities related to overseas aspect of organizational activities requires understanding the tax implications for individuals working abroad temporarily or on an ongoing basis. If you work abroad temporarily or casually for less than one complete year, you are likely to remain residents and taxable in the UK. So, but your residence position will depend on the statutory residence test. You may need to file a UK self-assessment tax return to report overseas earning and claim double taxation relief. So if you work abroad full time for the entire tax year and meet strict conditions such as spending fewer than 91 days in the UK and having fewer than 31st UK work days, you make case to be a UK resident. So in this case, you would not be liable to UK tax on earning from outside the UK. You may also be entitled to split the tax years into a residence and non-residents part, so potentially resulting in a refund on pre-departure employment earnings. Here is an example illustrate how the residency of a company incorporated overseas in determined if the central management and control of the company are exercised in the UK as indicated by UK-based directors holding board meetings in the UK. So the company is considered residents in the UK, but if the directors are based overseas and held board meetings overseas, the company would likely be treated as residents overseas. This example focuses on the, during the year ended 31st March, various limited UK residents company received an overseas dividend, £67,000. £500 withdrawing tax was withheld from the dividend on the rate of 5%. So basically, this example focuses on tax treatment of overseas dividend received by a UK residents. Company, if the company owns 50% or less of the voting power of the overseas company, the dividend is exempt from UK corporation tax, but included as franked investment income if the UK company owns more than 50% of the voting power. The dividend is exempt from UK corporation tax and not included as franked investment income. Regarding overseas branches of UK companies, 100% of branch profit are assessed to UK corporation tax with double taxation relief provided where the profits are also taxed overseas. Relief is limited to the amount of UK tax on the branch profit, and any trading losses can be relieved against UK profit. Uh, then explain the application of additional exemptions and relief. Capital allowance computations. When computing capital allowance, it is important to set up a separate column for different types of assets, uh, like main pool, special rate pools, short life assets, and private use assets. Main pool, this includes most assets except for those specifically allocated to other pools. A special rate pool is for assets with a long life or those with high capital costs. Then short life assets, they are assets expected to have a short life, typically less than 4 years, less than 4 years. Private use assets for sole traders only. This category contains cars with CO emissions over 130 grams. So it is worth nothing then companies do not have private use assets, as this category is specific to sole traders. Right. Everything is okay. Can you see my screen or hear my voice? No issues? Anyone?
No issue. There was that screen where it didn't have anything on there. Was that just the type
On my screen?
allowances and reliefs? There was one slide on page.
Slide 24, possibly.
Slide 24, I'll go back. Yeah. No, that's I explain in a further, that further exemptions and tax reliefs. That's it. So it's finished here, that, so it's just further talking about capital allowance. So it's just, annual, sorry, yes. Yeah, Hinesh, you can see my screen, anyone?
Let's see your screen.
So here we will that discuss the allowances available for capital expenditures. Annual allowances, investment allowances. This allows businesses to deduct the full value of qualifying expenditures on assets up to a specific limit from 1st April 2004 to April 1st 2016. So the AIA, or annual investment allowance limit, was £500,000 per year since January 1st 2016. So it has been reduced to £200,000 per year. So the AIA can be scaled up or down for short or long periods of account, and when periods span January 1st 16, the AIA is prorated between the periods. Writing down allowances, first year's allowances and cars. So writing down or written down allowances allows businesses to deduct a percentage of the assets value each year. For cars, the WDA rate is 18% per year in the main pool and 8% per year in the special rate pool. So based on a reduced balance basis, WDA can be scaled up or down for short or long period for account, and reduced writing down allowances can be claimed. Then we talk about when we talk about FYA, or first year's allowances. This allowance allows businesses to deduct 100% of the assets value in the first year. It is not prorated for short or long period. It is available for low emission cars and energy water saving plants with different thresholds for CO emission, determining allocation to the main pool or special rate pool. So understanding these allowances is essential for businesses to effectively manage their capital expenditure and optimize tax efficiency within the framework of capital allowances computations. Then furthermore, private use assets refer to assets used privately by a sole traders or partners, excluding employees. When accounting for these assets, the full value of the assets and any associated allowances should be shown in the column. So only the business proportion of allowances can be claimed. Private use assets are not pooled, and balancing adjustments may arise in two scenarios. Upon cessations, to deal with balances remaining after deductions of disposal proceeds, and when a non-pooled assets is sold, or when a column balance becomes navigate. When we comes to the short life assets, also falls under private use assets. Short life assets are those assets not considered to have a long life for accounting purpose. If an asset is not considered short life, the balance of expenditures must be transferred back to the main pool. So an election can be made to depool assets, but depooled assets must be disposed of within 8 years of the end of the period of acquisition. Uh, Short life assets are not considered capital assets, and their treatment differs from other assets. So assets not classified as SLA, short life assets, must transfer their balance of expenditure back to the main pool. And election can be made to depool assets, but these assets must be disposed of within 8 years of the end of the acquisition period. Depooling can be advantageous for planning purpose if balancing allowances are expected. Assets should generally not be depooled if they are likely to be sold within 8 years for more than their tax written down value, as this would result in balancing charge. Taxable total profit. So taxable total profit, uh, represents a company's overall taxable income, calculated by aggregating various source of income and chargeable gains, and then deducting qualifying, charitable donations, source of income contribution to taxable total profit, including profit of trades adjusted for tax, interest from non-trading sources, any other profit and income from land uh, or buildings in the UK. The pro forma for calculating taxable total profit involves summing taxable, trading profits, interests, other income, property, business income, and chargeable gains. So this total is then reduced by qualifying charitable donations paid to arrive at the TTP, or taxable total profit. Interest income from non-trading sources minus interest payable or on non-trading loans, property business income, which is treated as a single source of income and calculated similarly to trading profit. Interest payable on non-trading loans includes loans used to purchase rental property or shares in a subsidiary. Property business income is computed similarly to trading profits, although in the business tax context, you may not be required to calculate property business income directly. But you may need to include this income when determining taxable total profit. Accounting periods, companies are required to pay corporation tax on their taxable total profit in each accounting periods. So accounting period cannot exceed 12 months. If a company's account cover a period exceeding 12 months, it must be split into two accounting periods. Okay, so here is giving an example. For example, if a limited prepares account for 15 months ending on 31st December, there would be one 12 months accounting period ending on the 30th of September, and a second 3 months accounting period ending on 31st December 16. So when a period accounting exceeds 12 months, profit are divided between the accounting periods, uh, between the accounting period. So trading income is time apportioned before capital allowances are deducted. Capital allowances are computed separately from each period, interest income is allocated to the period in which it occurs. Property, business income, and other incomes are time apportioned. Gains are allocated to the period in which they are realized, and qualifying charitable donations are allocated to the period in which they are paid. Corporation tax payable, computing corporation tax payable is calculated by applying the corporation tax rate to the taxable total profit. So the corporation tax rate is set for financial years, which a financial year runs from April 1st in one year to March 31st in the next year. For example, financial years, if you can see here, 2016 runs from April 1st, 2016 to March 31st, 2017. So the formula to computing corporation tax is simply multiplying the taxable total profit by the applicable corporation tax rate, which is typically 20%. Continuing business operation involves understanding the basis period for tax assessment, which is typically the accounting period ending in the relevant tax year. For example, if a sole trader accounting period ends on December 31st each year, the basis period for the tax years, tax year 2016 and 17 will be the year ending on December 31st, 2016. Opening years, there are special basis period rules in opening years and closing years. Opening years of business operations, uh, uh, a special basis periods rules applies. In the first year, the basis period starts from the date of commencement and ends on the following April 5th. In the second year, if the accounting period ending in is 12 months or more, that period is considered. If less than 12 months, the first 12 months of trading are considered. The basis period ends on the accounting date in the third year. So if there is no accounting date in the second year, the entire year itself from April 6th to April 5th is considered as the basis period. Overlap profits occur when profits are taxed twice in the opening years of business. So these profit may be relieved uh, upon cessations of the businesses. The assessment focus involves ensuring the total taxable profit minus losses equal the total actual profits minus actual losses over the entire life of business. Uh, final year In the final year of business or operations, the business period starts at the end of the previous years. Basis periods and ends are cessations. For example, if here is you can see an example. If Nitin ceased trading on September 30th, 2016, and the basis period of the final year starts from July 1st, 2015 and ends on September 30, 2016. So overlap profits are deducted from the final year assessments. Changing the accounting dates. Changing the accounting dates involves different considerations based on the length of the gap between the old and new accounting dates. So if the gap is less than 12 months, the gap is taxed in the year of change. If the gap is greater than 12 months, overlap profit brought forward from the year before the change are relieved. Next one is national insurance contributions for the self-employment. Can you see my screen? Anyone?
Yes.
No issues?
Yeah, I can see the screen.
Okay, no. National insurance contributions or NICs for the self-employed consist of class 4 and class 2 contributions. So class 4 national insurance are calculated at 9% of profit between upper and lower limit main rates and 2% above the upper limits additional rate. Class 2 national insurance contributions are flat weekly amount, but they are not applicable if profit fall below the small profit thresholds. The upper limit for NIC is 43,000 pound as per 1617, and the lower limit is 8,060 pound for the tax year 2016 and 17. Individuals carry forward for trading losses. When a business experiences a trading loss during a certain period, it is treating it is treated similarly to how a taxable trading profit would be calculated. So this loss needs to be allocated to the appropriate tax year, such as assigning a loss from the year ending December 31st, 2016 to the tax year 1617. So these losses can be carried forward to offset against future profits of the profit of the same trade, but they must be deducted from the earliest available profit and cannot be saved for later use. There's no limit to how many years these losses can be carried forward, but if the nature of the trade changes, further relief may not be available. Individuals deductions for from total income. Trading losses incurred by individuals can be of the loss or the preceding tax year. It is important that partial claims are not allowed. The entire loss must be deducted if there is sufficient income available to absorb it. So, for example, if an individual's uh, uh, if an individual's sue incurred trading loss for she uh, incurred a trading loss for the year ending September 31st 2016 and had profit for the year ending September 13 2017, the loss can be set against the profit of the respective year starting with the year of the loss. So before recommending this relief, it is essential to consider whether using the loss would result in the waste of personal allowance or annual exempt amount, as this can significantly impact tax planning strategies. Companies trading loss for companies are the losses incurred in their trade activities. These losses can be set off against other profit of the same accounting period. Uh, Profits of the proceedings 12 months or carried forward to set against the first available profit from the same trade. It is very important that these losses must be relieved before considering qualifying charitable donations, and any unrelieved losses may carry forward for future use. Companies trading loss again. Companies have the options to claim relief against trading losses in different ways. Relief can be claimed against other profit of the same accounting period. Relief can be claimed against profit of the preceding 12 months. If relief is not claimed under the first two methods, it is automatically given against the first available profit from the same trade. Tax planning strategies should aim to relieve losses against profit taxed at the highest rates, considering the timing, and potential waste of any qualifying charitable donation or personal allowances. Uh, Companies' other losses, capital losses only set against current or future gains, never income, cannot be carried back. So other losses, when companies incur profit losses, capital losses, these losses can only be offset against current or future gains, never against income. Additionally, they cannot be carried back to offset against past gains. Trading loss performer. You can see here that trading loss performer, this performer for trading losses involves tracking trading profit and loss over different accounting periods. So this includes deducting any losses brought forward from previous years and considering uh, considering other income, net chargeable gains, and total profit. Loss reliefs then calculated, considered options such as carry back and qualifying charitable donation relief. Then loss relief planning, earlier relief, cash flow advantage of earlier relief. Planning for loss relief involves considering the timing of relief for the maximum benefits. Earlier relief can provide a cash flow advantage and offsetting losses against profit in year with the higher tax rate can result in greater tax saving. It is also essential to be mindful of potential waste of, QCD relief may be, wasted if there are no remaining profit to offset against. Other loss reliefs of property losses involves offsetting these losses against total income before uh, any QCD reliefs is applied for the current period. Excess losses can carried forward for further offsetting. Capital losses, on the other hand, automatically set against current year gains and can also be carried forward for future gains. It is important that capital losses can only be relieved against gains, not against income. So next one is analyze chargeable gains and capital gains tax liabilities involving overseas aspects of organizational activities. So any comments on this chargeable disposal personal assets, anyone?
No.
The understand chargeable gains and liabilities for capital gain tax involving overseas aspects of organizational activities. We need to consider three key elements. Chargeable disposal, this includes actions such as selling, gifting, or destroying assets which may result in a chargeable gains. A chargeable person, both companies and individuals can be subject to capital gains tax liabilities. And then chargeable assets, most assets are subject to capital gains tax when disposed of, with exemptions for certain assets like cars and specific chattels. Chattels, Hinesh, we discussed, that.
Yeah, they can be physical living objects. Doesn't necessarily
Yeah,
have
like you can say, for example, painting,
art.
yeah. So chattels, understanding these elements helps in analyzing the managing tax liabilities related to capital gains, especially in international context. Understanding basic computation for individuals. When we talk about capital gains, uh, For individuals, we are basically looking at the profit you make when you sell something for more than you paid for it. So to compute this gains, you subtract the cost of acquiring the asset from the periods you get, uh, uh, you know, uh, when you sell it. So uh, what count as cost? Well, it includes things like the original price you paid for the asset, any money you spent to improve it, and any cost you had when you first bought it. Charge to CGT for individuals or capital gain tax. Uh, when uh, we talk about capital gain tax, how much tax you might have to pay on these gains. First, you get deduct something called the CGT annual exempt amount, which is basically a tax-free allowance. So the rate for tax you pay depend on your overall income. If you're higher or additional rate taxpayer, you will generally pay 20% on your gains. If you are in the basic rate bracket and your gain fall within a certain threshold, you might pay just 10%. Uh, your gain made and selling residential properties except your main home, the rates are a bit higher, usually 18 to 28%. Losses for individuals. Dealing with losses for individuals, what if you end up making a loss instead of a gain? So you can deduct these allowable losses from any gain you have made in the same tax year. If you can't use up all your losses in 1 year, you can carry them forward to offset against future gains. But there are some rules about how much of these losses you can use in any given years. Next is computing gains and losses for a company. Uh, Companies also have to deal with the capital gains and losses. Calculation is similar to what individuals do, but companies get something called indexation allowance, which adjusts the cost of the assets based on inflations. So this helps to account for the fact that money losses value over time due to inflation. Uh, com uh, uh, Indexation allowances is calculated based on the original cost of the assets and any enhancement expenditures made over time. It is very important that the indexation allowance does not apply to disposal cost, only to the actual cost of the assets and any improvement made to it. Uh, Part disposal, understanding part disposals, when you only sell a part of something you own, like a piece of a land or share of a property, it is called a part disposal. So in these cases, you don't include the full cost of the assets in your calculations. Instead, you only consider a portion of it. For other costs like related to the part you still owns, you include a fraction of them in your calculations. This fraction is determined by the proportion of what you have sold compared to what you still have. Like if you see example here, Peter sold quarter interest in land he bought for 30,000 pounds. So the sale price was 18,000 pound, right? So, and there were 1,000 pound in cost related to the sale. Market value of the remaining 3 quarters of the land is estimated to be 36,000 pound. So to calculate the chargeable gain, we subtract the cost from the proceed of the sale. In the case, the chargeable gain is 7,000 pound. Chattels is an item, tangible, movable property. For example, as I said, painting. So, which are tangible, movable property like painting have specific rules regarding gains and losses for taxations. Gains on chattels sold for 6,000 pound or less as well as wasting chattels, with a useful life of 50 years or less are exempt from taxations. For gains on chattels sold for more than £6,000, where the cost was less than £6,000, a maximum gain calculation applies. Additionally, loss on chattel sold for under £6,000 are restricted to prevent tax avoidance. Uh, Connected persons, disposal between connected person are treated, differently for tax purposes, with the market value of the assets being used instead of the actual proceeds. Losses on disposal to connected persons can only be set off against gains on disposal to the same connected person, ensuring fair taxation. Then spouse and civil partners. Disposals between spouses or civil partners are considered no gains, no loss transactions, meaning they do not result in taxable gains or losses. This allows for the transfer of assets between spouses or civil partners without triggering a tax liability. Uh, Ensuring that, however, the receipt base cost for future disposal is set at the transfers original cost, ensuring that any future gains are correctly taxed. Examine the application of inheritance tax related to the principle of valuations and the reliefs available transfers of property to and from trusts, overseas aspects of organizational activities, and further aspects of administration. So, inheritance tax bases or essentials. Uh, Inheritance tax, which is tax you need to pay on the assets you leave behind when you pass away. Uh, First, we have got the concept of transfer of value. That basically means any actions that changes who owns something and has a potential tax consequences. So when it comes to inheritance tax, we need to know about chargeable property. This covers all the assets you own, like money, property, and any investments. And who's on the hook for paying this tax? Uh, it's the chargeable person. Okay. Chargeable persons, which typically means individuals. Uh, Now everything you own is included in this calculations. There are no free passes or exemptions when it comes to inheritance taxes. Occasion of charge, again, inheritance basis, occasion of charge, death, gift within 7 years pre-deaths, or other lifetime gifts. So there are few key times when inheritance times can come into play. The first is when something passes away. This is the most common occasion for inheritance tax. There's a rule about gifts made within 7 years uh, before someone dies. If you are given away assets within the this time frame, they might still be subject to inheritance tax. And well, don't forget gifts made during someone's lifetime that are not exempt for classified as potentially exempt transfers. Uh, these can also be subject to inheritance taxes. Lifetime gifts, these are, essentially any gifts you make while you are still alive that are not exempt from inheritance tax or classified as PET, uh, potentially exempt transfer. So the amount tax you pay on these gifts is calculated based on their value at the time they are given. When it comes to who pays the tax, it depends. If you are the recipient of the gift, you might have to pay. But sometimes the person giving the gifts, the donor, has to pay it, especially if they have set it up that way. So there are different tax rates for lifetime gifts and those made after someone passes away. For example, if you give something away and then die within 7 years, there might be additional tax to pay. Uh, Computations gift again. First, we have the concept of transfer of value. Which refers to the giving of gifts or assets. Now, there are some specific exemptions and allowances that can be reduced the amount of tax you owe. One important principle to consider is the dimension in value principle, which takes into account any decrease in value of an asset when calculating tax. When it comes to calculating the tax, we start with the chargeable transfer amount. Then we subtract any available nil rate band, which is a tax-free allowance. The remaining amount is what taxable, and we apply the appropriate tax rate to it. So for lifetime gifts, the tax rate can be either 20% or 25%, depending on who's responsible for paying the tax. For tax, so for sorry for gifts made within 7 years before someone's death, the tax rate is usually 40%. All good. Anybody can have an issue? See my screen, my voice, all good?
Yes.
Yeah.
Okay. So nil rate band available. The nil rate band is the amount of money you can give away tax-free either during your lifetime or upon your death. So when calculating the lifetime tax on a chargeable lifetime transfer, we start with the nil rate band available at the time of the gift. So then we subtract any CLT or chargeable lifetime transfer made within the 7 years before the gift was given. This gives us the remaining nil rate band available for tax calculations. Similarly, when calculating the death tax on CLTs and potentially exempt transfer or PETs made within 7 years before death, we start the with the nil rate band available at the time of death. So we then subtract any CLTs uh, and chargeable PETs made within the 7 years before death to find the remaining nil rate band available. Future computational points. There are a few additional points to consider when computing inheritance tax. Gifts made within 3 to 7 years before death may qualifies for for tapper relief, which reduce the amount of tax on based on how many years before death the gift was made. The percentage reduction in tax range from 20% to 80%, depending on the number of years before death, like 3 but less than 4 years, 4 but less than 5 years, 5 but less than 6, and 6 but less than 7 years. So uh, here it's important that any lifetime tax paid on CLT made within 7 years before death can be credited against the death tax on, but it will not result in a refund of tax already paid. Uh, Also, a tax rate of further computation. Summary of computation for tax on gifts in 7 years pre-death. A tax rate of 40% applies to the taxable amount. of gift made within 7 years before death. So this calculation involves the steps, tax on taxable amounts of 40%, tax less tax relief, apply the taper relief percentage provided in a separate documents to the tax on the taxable amounts. This reduces the amount of tax owed. Then chargeable percentage, subtract the taper relief amount from the tax on the taxable amount to determine the chargeable percentage. Lifetime tax paid, uh, lifetime tax for certain lifetime gifts, subtract any lifetime inheritance tax already paid. So inheritance tax due, subtract the amount from step 4 if applicable, from the chargeable percentage to arrive at the final inheritance tax due on the gift. Summary of exemptions and relief. Annual exemptions, 3,000 pound per tax years, carry forward 1 year only, use grant before brought forward. Each person can give away 3,000 pounds per tax year without incurring inheritance tax. So these exemptions can be carried forward for 1 year only, but only if the current year's allowances is used first. Lifetime gifts and death estates in interspouse civil partnership, partners exemptions. Gifts between spouse or civil partners are generally exempt from inheritance tax. Uh, Small taxes, you can give away small gifts of up to 250 pound for per person per tax years without offering your in without affecting your inheritance tax liabilities. Marriage exemptions, a certain tax-free amount can be gifted towards child or grandchild's uh, wedding, uh, towards a grand child's or grandchild's wedding, 5,000 pound per parent, 2,500 pound per grandparents party to marriage, and 1,000 pound for others. Normal expenditure out of income, gifts made from regular income that do not impact your standard for living are typically exempt from inheritance taxes. Death state, the death state refers to the total value of a person's assets to the time of death. To calculate the inheritance tax due on the state, follow these steps: identify assets, determine the value of all assets, including freehold property, excluding endowment mortgage, life insurance policy, uh, all other assets like cars, shares, banks, accounts, assets held in ISAs, uh, debts deducted, any debts owed by the deceased from the total value of assets, then funeral expenses, subtract reasonable funeral expenses from the remaining amount, exempt legacies, deduct the value of any exempt legacies left to charities, then gross charitable estate. This is the basically final value of the estate after all deductions are applied. Uh, Inheritance tax on the death estate is calculated as as per this pro forma. Gross chargeable estate refer to the value obtained in step 4 of the death estate calculations. Deductions, subtract the following falling from gross chargeable estate: residential nil rate band at death, a tax-free allowances for the value of a person's residence passed on the direct descendants. Nil rate, again, NRB or nil rate band, a tax-free allowance is applied to the total estate value gift made in the previous 7 years already included in the gross chargeable estates are deducted. So here to also avoid double taxations, taxable amount, this is the remaining amount after subtracting all deductions from the gross charitable estates. So inheritance tax payable at 40% basically multiply the taxable amount by 40% of determine the final inheritance tax liability on the death estate. Nil rate band applies to deaths on 6th of April 2017 or later. Is an addition available if the deceased estate include a home which is left to direct descendants, for example, children or grandchildren's. So maximum residence nil rate band is £100,000 for the tax year 2017 and 18. So this amount, it is important that to note that this amount may charge in future tax years. Payment of inheritance tax due, and transfer and due dates. Chargeable life trusts transferred between April 6 and September 30. Payment is due on the following 31st of April. Then transfer between October 1st and April 5th. Payment is due 6 months after the end of the month the transfer took place. Potentially exempt transfer or PET is becoming chargeable due to death. Payment is due 6 months after the death end of the month and transfer took place. PET or potential exempt transfer becoming chargeable due to death, payments is due 6 months after the end of the month of death. Additional tax due on CLTs within 7 years before death, payments is due 6 months after the end of the month of death. Estate at death inheritance tax is generally due within 6 months after the end of the month of death. But if estate accounts are delivered to HMRC earlier, the payment may be due at that time. Planning inheritance, planning strategies, use available exemptions and reliefs, gifts asset during lifetimes. Donor may survive 7 years. Tapper relief if survive 3 years. Annual exemptions available or freeze value of gifts, mean gifting assets freeze their value at the time of the gifts, potentially reducing the inheritance tax liability compared to if that the assets values increase over time. Married couples and civil partners. Married couples and civil partners can benefit from transferring any unused nil rate band from the first spouse to die to the surviving spouse. This can significantly reduce the overall inheritance tax burdens for the couple. The key points to remember: the unused portion of the nil rate band for the first death is equal to, from the first death can be added to the nil rate band available at the time of the second death. So to claim the benefit, an application must be made within 2 years of the second spouse death. So that's it for today. Here are some website to visit, evaluate income and income tax liabilities in relation to trusts, or assess the use of stamp taxes in the UK taxation system. For further reading, you can visit these websites. Also, you have available some ebooks and articles on your Moodles or learning management systems. You can check. So if there is any question, concern, issues, you can drop me an email at yasir@ukversity.co.uk. And thank you very much for joining me. Any questions, concerns, and issues, anyone?
No. I'm fine.
Okay. Thank you very much. I'm sorry, I know that you are a bit boring. Lecture was a bit long, but thank you for joining me, and see you next Sunday, same time, 11:30 for our second session of business taxations. Thank you very much, everyone, and have a nice day ahead. Thank you very much. Bye for now.
Thank you.